Hello there, welcome to my channel. In this particular video, our purpose is very simple and straightforward. As you can see on my screen, this is a financial model that we have built. This is a discounted cash flow financial model. And so all that we are coming to do in this video is to learn how to build this particular model and make it as professionally looking as possible. So if you are excited about learning all that I have in this particular video, then stick with me. If this is your first time on my channel, please subscribe to the channel and also consider liking the video if you find it useful. All right, so without wasting much time, let's get into business. So this particular model was built in one of my videos. So as you can see, it is a very dynamic model. So first of all, this is one of the, I've grouped the various tabs within the financial model. So when I click on one here, it's going to collapse, or it's going to collapse all the groupings for me. So as you can see, we have assumptions and drivers. We have statements of profit or loss, statements of financial position, also known as the balance sheet. The statement of profit or loss is also known as the income statement. We have the statement of cash flows or the cash flow statements. Then we have supporting schedules, and we have the DCF valuation model tab, and then also finally we have sensitivity analysis section. So this is a very dynamic, a very let me say comprehensive financial model as we have here. So you must stick with me. Do not skip any part of this video. Stick with me to the end, because I'm going to reveal a lot of tricks and tips that is going to help you build this professionally looking financial model you are seeing here. So what I did was that so to be able to see all the expansion, you can just click on the number 2 here, and it's going to expand all the group tabs for you to have a look at the model. So as you can see, we have assumptions and drivers, and for the assumptions and drivers, we started off by having a base case, that is the normal case or average case, as you want to put it. Then we had an upside case scenarios. So we had upside case scenarios, and then we also had downside case scenarios. Now it depends on what you want, what name you want to give it. The downside, you can say worst case scenario. The upside, you can say the best case scenario. And then for the base case, as I already said, you can say the normal case or the average case. All right. Then we have the active case section here. Now the active case section displays the current case that has been selected. So when I come here, we utilized data visualization in Microsoft Excel to be able to achieve this particular scenario switch function here. So when I come here and I click on and I change it to number 2, you could see that it changes the scenario, and then the share price, which we determined using the intrinsic value under the DCF valuation model, changes dynamically. So look at this. When I come here and then I select number 3, the price, the equity value per share changes dynamically, and that's what we have here as the share price. All right, so when I come here and then I come to my base case, which is number 1, I have there. So this is what we did. And when you come to the cases tab here, you will see that this is the list of the cases we had, and then we used data visualization on the data tab. So you come to the data tab, and then you come to the data tools column here, and then you see this particular bar here called data visualization. So we just click there, and then that is what we used to build or to achieve this particular scenario switch. So this is a very dynamic model, and so we are coming to look at how we did all of this. So as I said, we had assumptions and drivers. That is the starting point. Then with the assumptions and drivers, we are talking about we are basically talking about ratios. Okay, so we calculated what we call the revenue growth rate using our historical financial statements. Now, when you come here, you will see some figures in blue. In blue here, in financial modeling, we always put our hard-coded figures in blue so that we can differentiate them from formulas. Okay, so the formulas are what you can see in black. The other ones which you are seeing in blue are what we call the hard-coded figures. And to achieve this, you can simply go to F5 on the keyboard. You use the function key F5 on the keyboard, and that opens the what we call the go-to window. So this opens the go-to window, and then you go to special. So I'll click on the special, and then I'll come to constants, and it should include only numbers. So I'm going to unselect the text logicals as well as the errors, and then I'll hit OK. Hitting OK is going to select all the constants for me within the financial model. So all I have to do is to go to the Home tab and then select the font color, which is blue, and that is going to put all my constants into blue for me. So that is what we did. Okay, so that is what we did. Let me undo this quickly. So that is what we have there. So that is how to identify your hard-coded figures from the formulas. All right. Then so we calculated the assumptions based on the historical financial data. So as we have in the blue here, then from these calculated figures, we made assumptions for our base case. All right. So the base case is not too different from the assumptions that we have calculated, the ratios that we have calculated. So what are some of the ratios? As I said, revenue growth rates, the COGS as a percentage of revenue. We have SG&A as a percentage of revenue. So what we did is that most of the financial, the income statement items are as a percentage of revenue items. All right, and then we also calculated these days sales outstanding, days inventory outstanding, and then the days payable outstanding are the ratios we used in calculating our receivables figure, our inventory figure, and then the payables figure within the balance sheet or the statement of financial position. All right, so that was what we used to forecast those figures. So as we can see, we determined our base cases from this scenario. Then from the base case, we adjusted them to get our upside case. So in case everything works well within the forecast period, we can say that this is the best case scenario. So if everything goes according to plan, this is what we are expecting to achieve within the forecast period. And then the same applies to our downside case. So in case things get worse, this is what we are projecting our finances to be. All right, then whatever we select using the scenario switch here is going to be reflected using the in the active case section here. Now this is black, which means that it's a formula. So when you come here, you see we used the function choose. We use choose to determine our to make a choice between the three cases or assumptions that we made here. So using a choose, as you can see, we used so we utilize the choose function in addition to absolute referencing to be able to achieve our selected scenario or case. All right, so that is what we have there. Then we used the active case. Remember, we used the active case to prepare the income statement model. So that is what we have here, right here on your screen. And then we forecasted our accounts receivables, our inventories. So as we can see from the notes side here, we have indicated that some of the items remained unchanged. So we also forecasted our capital, our share capital, our accounts payable as well. So those are some of the things we did. Then we use our supporting schedules to forecast the rest of the items we saw on the balance sheet. All right, so as you can see, the PPE figure we saw in the balance sheet was calculated using the PPE schedule. We used the retained earnings schedule to obtain our retained earnings balance in the balance sheet, and then also we used the changes in working capital to get our net change in working capital, which was used within our cash flow statement. So this is a very nice model that we built together. So after building the three statement financial model, as we have seen here, together with the supporting schedules, we went ahead to build the DCF valuation model. Now, the DCF valuation model, what we do is that we take or we calculate our unlevered free cash flow model. This unlevered free cash flow model means that it does not take into account our liabilities or interest payments. All right, so we are talking about only our operating cash flows. Okay, our operating cash flows. That is what we are talking about. And so this particular figure, as you can see here, which is the EBIT or the earnings before interest and tax. So that is what we are talking about. And then we will subtract our operating taxes, which is found within the income statement. These two figures are found within the income statement. And then we add back our D&A or depreciation and amortization expense, which is a non-cash flow item. And then we also adjust for changes in working capital, and then we also adjust it for the capex or the capital expenditure within the cash flow statement to get our unlevered free cash flow to the firm. Unlevered free cash flow. So as we can see here, we have these figures there. Then we made some assumptions. Now this is the WACC. The WACC is the discount, is the cost of capital of the firm. Okay, and usually it's a complex calculation that we have to do, but in this particular model that we built, we wanted to make the assumptions as simplified as possible. So we just assumed a 10% WACC, which is the weighted average cost of capital of this hypothetical company. And then we also made an assumption for the growth rate, which is 3%. So we are saying that the cost of capital is 10%, and we are saying that the cash flows are going to grow at 3% per year. So that's the assumptions we made. So taking our free cash flows, which we have here, we calculated our discount factor using the WACC. Okay, using the WACC and the growth rate, and we multiplied the discount factor with the cash flow to get our present value. Now these cash flows are future cash flows. Okay, they are future cash flows, so we discount them into the present to get our present value. Then after that, we calculated our enterprise value, the enterprise value of the firm. So this is the value of the firm, that is the enterprise value, and then the value of the equity. So the value of our equity also is calculated here for us. Then we use the enterprise value. Okay, we used the equity value, to calculate the equity value per share. That is the share price of the firm. Now, what we do in real life is that we usually pick this particular value, which we also call the intrinsic value per share, and then we compare it with the current share price, and then we see if there is undervaluation, overvaluation, or the value of the share is fairly valued. So that is what we use the discounted cash flow model to do. Okay, so it is a valuation model that is most common. We have other valuation models such as comparative company analysis, and then we also have the precedent valuation model and all that. But the most common one is a DCF model. All right, so and the DCF model is very important because it takes into account the time value of money. Now, when you look at the model, you could see that we have some blanks
that are not actually white as compared to this white background. So this is to indicate that we intentionally left the those sections blank. All right, we intentionally left them blank. So that is it. As you can see, this is intentionally left blank, as you can see all of here. So this is how we can make our model professionally looking. Now, as you can see, when you look at this, you can see that the grid lines are up. How did we do that? We come to the view tab. When you come to the view tab, you see grid lines here. So when I check the grid lines, our grid lines will come back. So just wait for a moment and the grid lines are going to come. Then when I uncheck it, the grid lines will go off. All right, so that is what we did to turn off our grid lines. Then finally, what I want us to do is to make this particular model more professional. So first of all, let me group everything back to its original place. Okay, so I didn't even talk about the sensitivity analysis. So let's come to the sensitivity analysis. So what we do is that with the sensitivity analysis, we are talking about how a change in the assumptions that we have made is going to affect our the share value calculations. Okay, our share values. So as you can see, this is our assumptions. This is 10% WACC and then 3% growth rate. Now, when the WACC was 10% and the growth rate was 3%, our equity value is 651,460 and the enterprise value is 441,910. Now, let's come here. As you can see, this is 3% and this is 10%. So you can see that this is reflecting our enterprise value of 441.9. So when the scenario changes to 1%, in case the growth rate is now 1%, this is what our enterprise value is going to be when the WACC remains at 10%. But where the growth rate is 1% and then the WACC also reduces to 9%, then this is going to be our enterprise value. So the sensitivity analysis helps us to analyze the various assumption combinations that is going to result in particular enterprise values, as you can see here. All right. Now let's add a home page to our model. So what we are going to do is that, okay, first of all, let us change this particular blue here. So I'll come here and then I can change it to red, and then here I can come here and then let me change it to let me try and change it to this color here. Good. So we have that, and then when you look at the top here, we have a check. Now we want to make our financial model as error proof as possible. So what we do is that at any point in time, we want to issue or ensure that our financial model is working perfectly without any errors. So you see that when you build this particular financial model correctly, which I will encourage you to do, I'm going to leave the historical data in the video description, so you can download it and practice and then build your own financial model. And after that, you can come back here and then give your comments in the comment section and tell me how you have done with the building. So this is what we did. We used the if function together with the absolute function to determine whether the balance sheet has balanced or not. So that is what we did. So we are saying that if the absolute difference between the balance sheet figures, okay, that is our total assets and then the total equity plus liabilities, is greater than 1, then it is an error. Else it is what? Okay. Okay, so that is what we did. If the absolute difference between our total assets and then our total equity plus liabilities is greater than 1, then it is an error. Else it is okay. All right, so that is the command, or that's the function we issued for all of these okay we are seeing here. So it is telling us that it is not greater than 1, and so it is okay. That is what our model. When I change the scenario, it gives me okay throughout. It gives me okay throughout, as you can see there. All right, now let's add a background. So I'm going to insert a new sheet, and then I'm going to name it cover page. All right, so let me move this to the first one, and then also I'm going to move my historical data to the second one, and then this can remain like that. So let me come to my cover page, and the first thing I'm going to do is to select the entire page here by just clicking at the very top left corner of my page here, and then I'm going to remove the grid lines. So removing the grid lines there, and then I'll come to my home page, and since we have used blue a lot, let's change the fill color of our background to this blue here. Good. Then what we are coming to do is to say that we are going to so we can have something here. So what I'm going to do is that I'm going to the insert tab, and then I'm going to insert a symbol here, and the symbol I'm going to insert is this copyright symbol. So I'll get there. You can use your own style. So and then I can say the Gen Z Analyst right there, and then I can change the font color to white, and then also increase the font size, and then I can come here and I can write discounted cash flow model. Discounted cash flow model, and let me change the font color as well to white, and also increase the font size. Okay, and then I'm going to bolden it, and then what I'll do is to merge and center it right there, just like that. And what I'll do is that I'm going to have a content, table of contents. So just write contents there, and I'm going to have my historical data. I'll have 2 DCF model, and then 3 I'm going to have cases. So we have the contents there. Let me change the font color to white and increase their size a little. All right, then let's try and link these particular contents to the various tabs. All right, that's what we're coming to do. So I'll just come here and so what we are coming to do is to link this particular contents to the various tabs. All right, so let's come here. So the first one is the historical data. I'll right click, come to the link here, click on the link, then come to place in this document. Place in this document, I'll click there, and then this is my historical. So I'll click the historical and type the cell reference there. Okay, so it will open it at A1, that is okay. So I'll click OK. So that when I click on the historical data, it takes me straight to my data tab, historical data tab, as you can see there. Then I'm going to do same for my DCF model as well. So I'll come here, place it here, and then come to my DCF model, and I'll hit OK. And then I'll also come here, right click, link it to my cases as well, and then I'll click OK. So as you can see, this is looking very, very, very interesting. All right, so let me click and hold to drag, and then let me increase the font sizes a bit more, and my content also a bit more. All right, so another thing you can do is to probably uh, add uh, a bit of summary of whatever you have done. So if this is a real life financial model that we built, then we could have gotten more information. Whatever we are trying to achieve using the model, we will just summarize it here. So you can have what's an executive summary. Okay, so you can just have a brief executive summary there, so that whoever picks this model, by reading that, will quickly understand that, okay, so this is what I am expecting to see my model answer within my this particular model. All right, so that is it. Thank you very much for your time in this video. I encourage you to build this particular model on your own, and also make sure you give me a feedback after building that. I will be expecting your comments in the comment section. Please like the video, subscribe to the channel, and also consider sharing it with others so they can also benefit from what the Gen Z analyst is doing here. My name is Ernest, and I am the Gen Z analyst. Thank you for watching my videos. I will see you in the next video.